oil prices edged down a bit as data from the industry group American Petroleum Institute highlighted a rise in crude U.S. stockpiles. This reduced hopes of a smoother fuel demand recovery. Joining me live from London to discuss the oil market dynamics and other commodities is Lukman Otunuga, research analyst at FXTM. Good morning to you, Lukman. Welcome to the show. So I guess let's start with oil and how you've seen the recent trending movements of that particular commodity. How are you seeing things?
Good morning, and thank you for having me here today. Yes, we can see that there's some semblance of normality returning back to markets, and this positive sentiment has been reflected across oil, especially when we look at the fact that the commodity is appreciated actually 70% from the sub-zero lows. However, though, when we look at oil's valuation year to date, it's still down over 50%. Now, the main reason why oil is trading lower today and the previous days is the fact that we've seen that Russia is not too keen on extending the production cut beyond July. So this does raise questions over how sustainable the cut deal would be and if oil can trade higher. But when we look at the bigger picture, I think nothing much has changed. Yes, we have optimism over economies reopening, but there's still concerns of a slowing global growth and escalating US-China trade tensions, meaning in the medium to longer term, I think the path of least resistance for oil, WTI crude and Brent, points south.
Lukman, thank you for that. Are we tired of hearing Russia throwing a spanner in the works? This is what happened with the OPEC Plus meeting where they refused the cuts and Saudi Arabia just threw their hands up and said, okay, forget it, we're going into a price war. Now you've mentioned them again, now having misgivings, if you will, about extending the cuts past July. I guess we have to just deal with Russia because they're such a big producer, but aren't we getting tired of them disrupting markets the way they do?
Well, Russia's in a different position compared to Saudi Arabia and United States. While Saudi Arabia and US are actually in a trade deficit, Russia is actually faring well to the low oil prices. So they actually have less incentive to move ahead with the production cut deal compared to Saudi Arabia and US shale. But going back to what you were saying, I think especially the aggressive price war we saw a few weeks back, when we look deeper into the matter, I think it was more to try to remove US shale from the equation because think about it, as low oil prices have been really hitting Saudi Arabia and Russia, US shale production has continued to rise. But with them being out the equation, this could offer some market share for Russia and Saudi Arabia.
Thank you so much for pointing that out. So there's no matter what we feel about Russia, you've pointed out here it's a market thing. It benefits them. They're able to survive with these lower prices. However, I do want to throw something in here. As you mentioned shale, them trying to take them out. As prices rise back up, that helps the shale players, does it not?
Naturally. So what we saw a few weeks ago when oil hit sub-zero for the first time in history, it got to a level where many US shale productions had to stop producing and many went bankrupt and had to close. But it's a vicious cycle of oil prices right now because if you look at WTI crude and Brent, they're both trading around $30, $35. Once oil trades back to $40, this becomes quite profitable for US shale producers. So we're going to have a scenario where they'll jump back into the markets, so oversupply becomes an issue, and we're back to square one where oil prices remain at depressed levels.
Fascinating round-robin situation there with oil. It's great to witness. Let me ask you about gold and how gold has been moving recently. It's blew past 1,500. I think blew past $1,600 an ounce. Well, how are you seeing things with gold?
Yeah, so it's blew past 1,500, 1,600. 1,700, and it's trying to make its way to 1,800 actually. So with gold, I think over the past few months, we've been speaking about this commodity. This is the perfect environment for gold to flourish. There's concerns of a slowing global growth, low interest rates, the coronavirus really hitting major economies. But now the dynamics are starting to change because when we move towards June, I think the outlook for gold is clouded by conflicting market themes, meaning that, yes, we have renewed tensions between the two largest economies in the world and concerns over the global economy experiencing a recession not seen in a century. But on the other side of the equation, there is this false sense of optimism over, the economy recovering quicker than expected, and major nations easing lockdown measures. And I think we're going to see a really aggressive tug of war with gold prices in the coming months. Overall, though, I want to move to the technicals. If things continue to remain intact and trade tensions continue to intensify, gold has the potential to test 18,000 in the medium to longer term.
Wow, wow, wow. And with this latest news, which we already took, with China passing their security law legislation on Hong Kong, the U.S. threatening something, I don't know what the President Trump is going to do. That's kind of the tensions you're referring to that could push gold past $1,800 an ounce, yeah?
Absolutely. The global economy is in a very fragile position right now, despite what you may be seeing in stock markets and risky assets. Right now, we're in a speculative phase, meaning that there is this hope that the negative impacts of the coronavirus, may not be as bad as most anticipate. But I think many investors will have a bitter taste of reality in the coming weeks when we have data from the United States, Europe, the United Kingdom, really illustrating how badly the coronavirus has hit many major economies, including emerging markets. Now, going back to what you were saying about the trade developments, this is another major issue because now we're seeing tensions moving from trade to stocks. So the United States actually decided to ban, many Chinese firms from listing on the New York Stock Exchange, which will hit many Chinese firms in the longer term because it reduces their brand credibility. So moving ahead, this raises questions over the possibility of a phase 2, phase 3 trade deal. And I think it's the last thing markets or the global economy needs right now, especially when it's trying to recover from the negative impacts of the coronavirus.
Thank you so much for pointing that out. It's really quite interesting seeing how things are going to play out there. Let's also touch on foreign exchange. I guess the dollar, the euro, the pound, the yen. How's that playing out?
Yeah, so looking at the dollar, I think the dollar has an unfair advantage against other G10 currencies. It's the king of the hill. The dollar is seen as a reserve currency. So really, no matter how bad things are in the United States, no matter how low the Federal Reserve may cut interest rates, I think investors are still going to continue rushing towards the dollar. That's where when we look at the dollar's valuation, especially against G10 currencies and other emerging market currencies, it still remains the king of the hill. I heard you mention the pound. Living in the UK, I don't really like how the pound is looking. We have Brexit. Brexit talks are going to commence next week, and I can't just help but feel another sense of deja vu because we have another last chance for the United Kingdom to really extend the Brexit deadline beyond 2020. If this doesn't happen and the UK ends up crashing out of the EU at the end of the year, this is really bad news for the UK economy, especially for the British pound. But we're living uncertain times right now, so for investors out there, especially when uncertainty remains the name of the game, I'll be looking at the dollar and the Japanese yen, which is considered as a safe haven destination.
All right, research analyst at FXTM, Lukman Otunuga. Thank you.